Welcome to TradeTheMBI.com. This is John's reports for the 7th. It's interesting because sometimes I get some comments, criticism that, John, you're just too nonchalant about the idea of, the positive extremes and which ones are going to fill. And of course, we've been talking about, the positive extreme coming back down to this 44, 46. What did the low of the other day? 44.47. And we talked about this from the moment it broke out. Was even more evident on the 50K chart that we were talking about. And you just have to mark the lines and wait for the signaling. And we knew that we were getting extreme here when we had the MBI magenta moving up above, not just above the 40 line here, but it got over the mid 50 range. In fact, what was that peak? 51. It's way outside of normal, which just meant they were pushing really hard to get a whole lot of nowhere. And once the DOC spread started, it was just a matter of waiting for that magenta to break down a little bit, and that took place right over here. And it fills pretty darn quick. It didn't take much. I mean, some people say, "Yeah, but that was a dramatic." It's like that wasn't a dramatic move, and I neither get excited about the large moves up or down as they're relative to what the expectation is. Now, it's interesting that we didn't see the NASDAQ pull back to the same degree that the S&P did. That's interesting because it poses the idea that we could see extended decline within the S&P as the NASDAQ fills that section, unless they're willing to step into the discount in the S&P while moving out of the NASDAQ. That can happen as an alternative, but it does suggest that the S&P is likely to suffer further decline if the NASDAQ isn't able to support things. And at this particular stage, short-term buyers starting to make a move, potentially enough. And if we get that DOC orange between cyan and red, that will be a continuation move, unless we get just a complete breakdown and going all the way through. We can see shakeout breaking down. I'm looking forward to see if it goes under zero, and particularly if we get a dip below the red line. Once it's in the green, if you get that short-term buyer turnaround, we could see fund money popping in that has just started. That would be enough to provide the support necessary. Just the question becomes, do they move more into treasuries with the yield being significant enough and facing zero risk? It's a very appealing thing if oil wasn't making a move. So you see the dynamic when oil was declining. Treasuries made all the sense in the world. Once oil started up, okay, now you got to worry about inflation and whether or not that yield you're getting is being wiped out by future price increases that are going to be taking place. And this becomes that overriding dynamic. And as long as they allow oil out of control, some people say, well, they can't control, those aspects. Well, of course they can. We've already seen how easy it is to move energy prices lower if you want them to. I mean, the resources within the U.S., once they were turned on, we proved that you can actually push oil to the point of near non-profitability. So that's just a governmental choice at this particular stage, because certainly the market forces would do it if they could, because they want to make money, plain and simple. And they're not going to object when you give them free cash by doubling the price of it for no arbitrary reason, where they even have to use less product to make as much. So from their standpoint, that's a great deal. And people would say, oh yeah, but, and it's like, well, there's always these considerations, but didn't have to have sanctions on Russia and all these other things. And of course, Eurozone, they're seeing the effect of that, because you can't ignore the fact that as those oil prices increase and winter approaching, it's devastating for the euro because they have nowhere to make up for it. When their own allies are basically defeating them from an economic standpoint. So you have to look at it from a dual context. Not only are they fighting the East, but you're also fighting your European neighbor, who's your competing economy. So, but it does hurt the S&P as the euro drops. So that's why you might see more outside move from the euro from that standpoint. And again, we're getting into that danger zone. They're really going to have to fight to support euro coming into these ranges. Otherwise, you get back to a parity again. And again, it just becomes problems from a reserve standpoint, liquidity. It can really create a snowball effect. So it's a fine line the Fed really has to tread when it comes to these. And so while they may jawbone a little bit more on rate rises with what oil's doing in that, do they have the real flexibility to do that? I mean, we already see what it does to the deficits from the U.S. Not that they care; they just make up new numbers. But it gets to a point where the exponentiality of it is just not sustainable, and something is going to have to be changed or in order for it to work out. The suppression within gold is strange in that aspect, but as we've talked about, the paper trade on gold, and that is the only way to manipulate its overall demand pricing in that, and it's effective a lot of times. Still, the upward bias for gold is built into it. It's just a matter of waiting for the correct signal when the bigger players are going to jump into it. And likewise, Bitcoin and them, with the amount of uncertainty and just no need to be playing into that space, they're just biding their time. And probably what we're seeing is just an accumulation from bigger elements. They weren't going to fall for the buy the news. Well, yeah, you buy the rumor, sell that news, and that's exactly what they did. And it was predictable for us. I mean, we saw, again, positive extremes coming back to the lows right there. We exceeded it. No shock. I mean, none of this is what some people, it's like foretelling the future and that, but no, they're telling you in advance what they're going to do. All we're doing is saying, okay, yeah, we recognize it, we see it, fine, we agree. We're not, there's no need to fight you about it. We just go along with it. So this is what we were talking about from the 50K standpoint. Big spike up, positive extremes started right there. And even as it was happening, I'm like, it's just a matter of waiting for the correct signaling time. And as long as you have DOC steel under these longer areas, is something I've been working with on alteration within the program to get it to where we finally reach that critical mass point where it normalizes back up from being at a strong reserve area, because it just means there's just a lot of power from short-term buyers to keep things up. And so you don't get a whole lot of move. Yes, technically, you still end up with the sell signals, but oftentimes they maybe just retrace to the 76%, as it did in this particular case. And then you get a little bit of a pop back up. But once that's been cleared out, then your secondary signals become a bit more powerful. And then once we started getting white MBI spikes, and particularly repetitive ones, reaching the 0% were obvious, and it's continued from there. And then this most recent spike of MBI magenta, and that not able to breach the 23% in any significance with that extreme dip here in the shakeout. When you get that kind of deep red, like I said, you have to come back up. It rolls back down again, and you look for a shallower secondary P2 pivot, which some people would just call a divergence. Matching or lower lows with improved readings indicate that it's being bought up, and those are the plays every single time, and it doesn't change. When we look at it from an intraday standpoint, started early in the morning and just there was no interest. And as soon as you reach a point where there just aren't enough stops being hit, you get the buy back up to encourage some more people back into the scenario. And if we ignore all of that time, you get the same thing, fills it right back in after they got those new buyers to get stopped out and pop it back up again. We're off modestly here at the pre-market setup, but again, it's problematic. There are definitely going to be some issues if new buyers don't step up to support the S&P. We'll see if the Nasdaq's able to fill back completely those positive extremes. Now, this is what I would point out. If the Nasdaq is able to support within there, you're going to get a significant bounce from that, because it would indicate that the shorts that jumped into their heavy got overwhelmed. And that's how you get those big giant turnaround days. So that's the long and the short of it. There's a lot of extra in there. As always, though, trade well. We'll talk in later. Look for me on the Skype chat.